real. Thank you so much for clicking on this video. If you are new here, welcome to this fun, informative, positive, quirky channel where I discuss all things lifestyle for your mental, physical, spiritual, and financial. If you are a returning subscriber, thank you so much for being real and being amazing and continuing to support my antics. Now, as you can see by the title of this video, we are going to be talking about loans, mortgage loans specifically. Now, in a perfect world, we would have an ideal, abundant amount of money in which we could purchase anything that we want or we need without worry, without stress, and we would be free. However, in this matrix, that is a little harder to obtain. Therefore, we have lenders. Now, lenders allows us to borrow large amounts of money as long as we legally promise to pay them back within a certain period of time, in addition to half of our soul. Now, I will be grouping your loan options into two main buckets, the first being conforming loans and the second being non-conforming loans. Now, conforming loans just means that Fannie Mae and Freddie Mac are able to buy the loans from your lender. I consider Fannie and Freddie to be Uncle Sam's children and sort of like the top dogs of the loan industry, and I imagine them to look a little something like this if they were real people. However, in reality, they are just organizations established by the government to boost the housing market. So if they meet Fannie and Freddie standards, then they're considered conforming loans, and if they don't meet their standards, meaning they can't afford them or they can't completely regulate them, then they're considered non-conforming loans. Now, there is one type of conforming loan that you are probably familiar with, and that is the conventional loan. Now, a conventional loan just means that it is not insured by the government. This makes it a bit riskier for lenders because if a home buyer defaults on their loan, meaning they fail to pay it back in time, then the lender doesn't get their money, they hire a debt collector, they ruin your credit, and then you're at risk for wage garnishments and lawsuits, and it just gets sticky. So because of all of that, eligibility requirements for conventional loans are a bit tougher to meet. Now, to be eligible for a conventional loan, you have to have a minimum credit score of 620. However, if your score is 740 or higher, you will be eligible for a down payment as low as 3%. Now, this varies depending on if it's your first home and if you're getting a single or multifamily unit. Now, for a conventional loan, your debt to income ratio has to be under 36%. Now, there are some lenders that will accept a DTI as high as 50%. So just confirm when you're shopping around for a lender. Now, your debt to income ratio or your DTI just shows you how much you owe in various debt compared to how much you earn on a monthly basis. You can calculate your DTI by taking all of your monthly debt payments and dividing that by your total monthly income.
I'm sick of worrying about the government. I can't eat. I'm broke.
Now, for a conventional loan, if you put anything under 20% down for your down payment, you will be responsible for purchasing PMI or private mortgage insurance. And this is because lenders require that you as the buyer pay for some insurance so that it kind of protects them a little bit.
I say no, I don't want it.
Now, once you have 20% of equity in your home, your PMI can be removed. And equity is pretty much just the difference between how much your home is worth and how much you owe on the loan. Now, the next main bucket is the non-conforming loans, and there are three main types of non-conforming loans, and that is your FHA, your USDA, and your VA loan. Now, the FHA is backed by the Federal Housing Administration, and this is a popular mortgage for buyers who may not have as much money saved for a down payment, they have limited income, or a lower credit score. Now, for an FHA loan, you need to have a minimum credit score of 500. Now, if your score ranges between 500 and 579, you will be asked to make a down payment of at least 10%. And if your score is at a 580 or above, you could be eligible for a 3.5% down payment. Keep in mind that with an FHA loan, if you put down anything less than 10% for your down payment, then you will be responsible for paying PMI for the life of your loan, regardless of your equity, meaning that payment will not drop off. With an FHA loan, your debt to income ratio should be under 43%. However, again, some lenders may take up to 50%. Keep in mind that the property has to be your primary residence and has to fall within the property and income requirements, which I will list above. Now, the next main non-conforming loan type is the USDA, and this is backed by the U.S. Department of Agriculture. Now, this is a less popular loan type mainly because of its location restrictions. With a USDA loan, you are required to purchase a property in a rural area. Now, when a lot of people hear rural, they're thinking farmland, the countryside, and that's not always the case. So rural is actually defined as any place with less than 50,000 inhabitants and that is not adjacent to an urban area. So there's a lot more options than you probably think. Honestly, I'm not even mad at the farmland and the pastures, okay?
If I had looked into USDA loans a little bit more when I was shopping for a home, I probably would have went with one.
The USDA eligibility site offers a map where you can actually type in the address of the property to confirm if it's a rural area, or you can just Google rural cities or rural counties in your state to see if you have any. The USDA site offers a map where you can actually type in address. I gotta open the door, I'm sorry. There is no down payment required and there is no minimum credit requirements. However, it is best to have at least a 640, therefore you can avoid the manual underwriting and a lender will be more likely to approve you. This loan does have income requirements depending on the city and state that you purchased the home in. With this loan, there is no PMI, however, there is a guarantee fee that is equal to 1%.
Anytime I'm filming, she has to be near, she has to be playing, doing something, like she can't just vibe.
There is no PMI, however, there is a guarantee fee, which is pretty much similar in protecting the lender, and this fee is typically 1%. You can choose to pay this amount up front or have it bundled into the monthly payment. The next main non-conforming loan, and in my opinion, the most popular and beneficial loan, is the VA loan. Now, this loan is backed by the Department of Veteran Affairs. This loan is, oh my gosh, it's in a box. And then when I kick you out, you're gonna cry. You're gonna cry. This loan is restricted to veterans, active duty military personnel, and surviving spouses. So with this loan, the VA does not set minimum credit requirements. However, some lenders may set their own. With a VA loan, there is absolutely no down payment and no PMI required. However, there is a funding fee, so they get you somehow. You can choose to pay this amount up front or have it bundled into the loan. This loan typically offers the lowest interest rates and prevents lenders from adding on additional fees within the closing costs. With this loan, you do have to meet the VA minimum property requirements, which I will list above or put some information in the description box. All right, those are the main mortgage types. Keep in mind that with the different types, you are able to select either a fixed interest rate or an adjustable rate mortgage, also known as an ARM. And the main difference between the two is that a fixed rate is just a set interest rate that is the same for the life of the loan, meaning your total monthly payments will be constant and never change. And with an ARM or an adjustable rate mortgage, your interest rate is fixed for a set time frame and then it becomes variable and can fluctuate with the market after that time frame.
Your interest rate is typically lower during that fixed period, and then after the period is over, you're pretty much thrown to the wolves.
With all of the different loans, there are different term options as well, so you can choose whether you want maybe a 5, 10, 30-year loan mortgage. Keep in mind that the longer the term, the lower your monthly payments will be. However, the downside to that is that the longer the term, the more payments will be going towards the interest versus the actual principal balance. I really hope this video was helpful. Please give it a big thumbs up if it was. That really helps me out. Leave a comment if you're feeling inclined. Let me know your thoughts. Thank you so very much for watching. I will see you guys in the next video. Be interested in. Ow, you scratched the crap out of me. I'm losing my mind.